Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is Robert Spinlove to discuss the current economic conditions. Robert, there are a lot of interesting things happening in the economy right now. But I think one of the most relevant is the most recent jobs report that just came out. This was the first employment report that came out post Hurricanes Harvey and Irma. Can you kind of go through some of the things we saw in the report, some of the highlights?
Yeah, it was a really interesting report. So the Bureau of Labor Statistics releases their monthly employment report on the first Friday of every month for the previous month. So we got the data for September just a few weeks ago. And what it showed was something really interesting. We were expecting about 100 to 150,000 jobs to be created in the nation's economy. When the number came in, it was losing 33,000 jobs. So a big surprise over what people were estimating was going to happen. What's also interesting is kind of the underlying data behind that. So we lost 33,000 jobs, but the unemployment rate dropped from 4.4 to 4.2%. You would think that if you're losing jobs, that unemployment rate would go up, not down. We also saw the labor force participation rate go up a little bit. So again, we're pulling more people off the sidelines and into the job market. And then we saw wage growth jump from 2.5 to 2.9%. Again, that would be an indicator of a stronger job market, not of a weaker job market. So the explanation is, it starts to get a little nuanced, but it's really interesting. The hurricane impacts essentially messed with all of our results. So what we know is that about 8% of the U.S. population lives in areas that were affected by the hurricanes. This is, by the way, this is mostly Texas and Florida. The hurricane in Puerto Rico was not affected in time for this report. That's 11 million people that were impacted by this. And one of the biggest areas that was hurt by this was food and drinking establishments. They lost about 100,000 jobs. So that had a huge impact on their overall workforce as well. So what it did was, it actually, because food and drinking establishments are often lower paying areas of the labor force, so it actually moved that median up a little bit higher. And then we just saw kind of overall areas where it was causing distortions with the overall employment report, with that unemployment, with that wage growth, with that overall labor force participation. So overall, what we know is that the hurricanes definitely had a huge impact. That 33,000 loss broke 83 consecutive months of job growth. So over 7 years of job growth are now over because of this. But we also expect that, as bad as the September employment report was, we expect October and November to actually be a little bit higher. Because while those jobs were lost, they were temporarily lost. And now that we're in the rebuilding stage, we could see additional jobs created, especially in areas like construction. And a lot of those jobs that were lost will be restored during that rebuilding. So on a net, I think that the net impact of the hurricanes could either be zero or could possibly even be positive as you see more investment from the federal government coming in.
Wow, that's interesting. And I know you touched a little bit on wage growth. And I know wage growth year over year has been stuck around 2.5%. Like you said, we saw it coming up a little bit, but that may be distortions from the hurricane. Something that plays into that is kind of the persistent low inflation that we've been seeing, and something I know that the Federal Reserve has been very concerned about. Can you kind of go into that a little bit and see what we're seeing?
Yeah, this is one of the structural issues that the Fed is really struggling with. So the Federal Reserve, one of their major ways of affecting the economy is through what they call the federal funds rate. And it's the shortest term and lowest interest rate in the economy. It's essentially the rate that banks charge each other for overnight loans, or the Fed charges the banks for overnight loans. And the Fed, before the Great Recession, had the federal funds rate around 5%. And then in reaction to the Great Recession, they dropped it all the way down to essentially zero, and kept it at zero for several years as a way to fight the recession. Now the recession is over, jobs are growing, the economy is improving, GDP is up. The Fed wants to get that interest rate back to a normal level. they've said that their goal is 3% interest rate for that short term. So over the last 2 years, they've raised rates 4 times. They usually raise it about 25 basis points or 1/4% every time they raise them. So we're right around 1% to 1.25%, and they want to continue to raise those rates. But the problem is, Janet Yellen has said very clearly that they will be data dependent on everything they do.
Yeah.
And inflation, and their inflation goal is to have inflation at around 2%. But inflation is not coming in where Janet Yellen wants to see it. It's been coming in consistently below 2% for several months. So they're really struggling. In fact, just recently, Chairman Yellen gave a speech where she said, "We don't know why this is happening. We're a little bit dumbfounded, but we expect inflation to rise over the next few months." So it's been staying low, lower than they expect, and lower than you would expect to see with a tightening labor market and strong growth. With unemployment at 4.2%, we should have higher inflation. But it's just not happening yet. But the Fed is confident that inflation will come in higher, and they'll be able to continue on their interest rate raising path over the next few years.
Well, I know another significant action they're taking is back in September they announced that they would begin to reduce their balance sheet holdings. Can you kind of walk us through maybe what that means and what it is they hope to gain by doing that?
Sure. So we talked about the Fed's ability to influence the economy through short-term interest rates, and that's by their direct federal funds rate. They also have the ability to impact longer-term interest rates, but they do that through bond buying in what they call the Fed's balance sheet. So literally what the Fed does is they go out on the open market and they buy bonds, and then they can also sell those bonds. So what the Fed did, going into the Great Recession, the Fed's balance sheet was about $800 billion. Then during the Great Recession and in response to the Great Recession, they started buying bonds like crazy. They bought mortgage-backed securities, they bought treasury securities, were probably the 2 biggest areas that they bought. And they increased their balance sheet from that $800 billion up to $4.5 trillion, the largest it's ever been, and the biggest increase that the Fed has ever gone through. So now they've got $4.5 trillion in assets, and the concern is that as it stays at a very high level, that it could be creating asset bubbles. They're worried about the stock market, they're worried about the real estate market, and they want to make sure that they're not creating a situation that creates these bubbles. And so the Fed has committed that they want to drop down that balance sheet. Now, we don't know how low they're going to try to go. I think they should go probably about maybe half of what it is now, so maybe about $2.5 trillion. But there is concern since it's never been so high. They've never sold off before. So it's the first time it's ever been done. So we don't know how the markets will react. We don't know how different participants will react. So Chair Yellen has been very careful about messaging how they're going to do it, the process they're going to follow. They're going to do it very slowly and very meticulously, and they're messaging it very clearly to try to get the market comfortable as they try to bring this their balance sheet lower and normalize overall market conditions.
Right. Well, it sounds like the Fed is really trying to thread the needle here, and it's going to be interesting to see when Fed Chairwoman Yellen's term comes up at the beginning of the year here, what's going to happen, whether the president is going to pick somebody else or continue down the same path.
Yeah, you never know what President Trump will do. There's a chance that he could reappoint Chair Yellen, but he's also actively interviewing several people, so we'll have to watch and see.
Thanks for the analysis, Robert.
Sure.
Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.